Assalamualaikum friends, welcome back to my YouTube channel. Today our topic is long-term care insurance. Long-term care insurance is an insurance product sold in the United States, United Kingdom and Canada that helps pay for the cost associated with long-term care. Long-term care insurance covers care generally not covered by health insurance, Medicare and Medicaid. Individuals who require long-term care are generally not sick in the traditional sense but are unable to perform two of the six activities of daily living, such as dressing, bathing, eating, toileting, continence, transferring, and walking. Age is not a determining factor in needed and long-term care. About 70% of individuals over 65 will require at least some time of long-term care services during their lifetime. About 40% of those receiving long-term care today, they are between 18 and 64. Once a change of health occurs, long-term care insurance may not be available. Early onset Alzheimer and Parkinson's disease occur rarely. Long-term care is an issue because people are living longer as people age. Many times they need help with everyday activities of daily living and require supervision due to severe con- cognitive impairment that impacts women even more since they often live longer than men and by default become caregivers to others. Benefits. Long-term care insurance can cover home care, assisted living, adult daycare, respite care, hospice care, nursing homes, Alzheimer facilities, and home modification and to accommodate disabilities. If home care coverage is purchased, long-term care insurance can pay for home, often from the first day it is needed. It will pay for a visiting or live-in caregiver, companion, housekeeper, therapist, or private duty nurse up to seven days a week, 24 hours a day up to the policy benefit maximum. Many experts suggest shopping between the ages of 45 and 55 as part of the overall retirement plan to protect assets from the high cost and burdens of extended health care. Other benefits of long-term care insurance or long-term care insurance, many individuals may feel uncomfortable relying on their children or family members for support and find that long-term care insurance could help cover out-of-pocket expenses. Without long-term care insurance, the cost of providing these services may quickly deflect the savings of the individual and their family. The cost of long-term care differ by region. The U.S. government has an attractive map of estimate the cost by state. Premiums paid on a long-term care insurance product may be eligible for an income tax deduction. The amount of deduction depends on the age of the covered person. Benefits paid from a long-term care contract are generally excluded from income. Some states also have deductions or credits and proceeds are always tax-free. Business deductions of premiums are determined by the type of business. Generally, corporation paying premiums for an employee are 100% deductible if not included in employee's taxable income. In United States, Medicaid will provide long-term care services for the poor or those who spend down assets because of care and exhaust their assets. In the most states, you must spend down to $200,000. If there is a living spouse partner, they may keep an additional amount. A welfare program, Medicaid, does provide medically necessary services for people with limited resources who need nursing home care but can stay at home with special community care services. However, Medicaid generally does not long-term care provided in a home setting or for assisted living. People who need long-term care often prefer care in the home or in a private home in an assisted living facility. Types of policies. Private long-term care insurance is growing in popularity in the United States. Premiums, however, have risen dramatically in recent years, even for existing Policy holders coverage cost can be expensive when consumers wait until retirement age to purchase LTC coverage. As they relate to US policies, two types of long-term care policies they offered are traditional policies are the most common policies offered traditionally. Policies premiums like automobile insurance premiums are paid on a continual basis. If unused or no premiums are returned, however, if the policy has a return of premium rider, a death benefit will be paid to the beneficiary if the insured dies at a time when benefits received under the policy are less than the premium paid to the insurance. The amount of the benefit is equal to the excess of premium paid over benefits received. Combination or hybrid policies are combination of a life insurance or an annuity with long-term care insurance. Similar varieties of these combinations exist as they relate to U.S. income tax. Two types of long-term care policies offered are tax qualified policies are the most common policies offered. ATQ policy requires that a person one be expected to require care for at least 90 days and be unable or to perform two or more activities of daily living, eating, dressing, bathing, transferring, toileting, continence without substantial assistance. Hands, no, or standby. Two. For at least 90 days need substantial assist due to an severe con- uh, con- cognitive impairment. In either case, a doctor must provide a plan of care. Benefits from a TKO policy are non-taxable. Non-tax qualified was formerly called traditional long-term care insurance. It often includes a trigger called a medical necessity trigger. This means that the patient's own doctor or that doctor in conjunction with someone from the insurance company can state that the patient needs care for any medical reasons and the policy will pay NDQ. Policies include walking as an activity of day living or usually only required of full inability to perform one or more activity of daily living. The Treasury Department has not clarified the status of benefits received under a non-qualified long-term care insurance plan. Therefore, the taxability of these benefits is open to further interpretation. This means that it is possible that individuals who receive benefits under a non-qualified long-term care insurance policy risk facing a large tax bill for these benefits. However, non-tax qualified policies are available for sale. One reason is that consumers want to be eligible for the tax deductions available when buying a tax qualified policy. The tax issues can be more complex than issues of deductions alone, and it is advisable to seek good counsel on all the pros and cons of a tax qualified policy versus a non-tax qualified policy. Since the benefit triggers on a good non-tax qualified policy are better. By law, tax qualified policies carry restriction on when the policy holder can receive benefit. One survey found that 65% of purchasers did not know whether or not the policy they bought was tax qualified. Once a person purchases a policy, the language cannot be changed by the insurance company, and the policy usually is granted renewable for life. It can never be cancelled by the insurance company for health reasons, but can be cancelled for non-payment. Most benefits are paid on a reimbursement basis, and a few companies offer indemnity based per diem benefits at a higher rate. Most policies cover care only in the continental United States. Policies that cover care in select foreign countries usually can only cover nursing care and do so at a rated benefits. Thank you for watching my video. Please subscribe my channel and also like my videos.